Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. I'm dressed like this today because we're starting our festive celebrations here on NDTV Profit, and so that, on that note, let me wish you and your families a very, very happy Dhanteras in advance, happy Diwali in advance, and season's greetings. And at this time of the year, the tendency is to talk about a few things, among them precious metals, but I thought, why not have a holistic conversation about portfolio strategy from Diwali to Diwali? And for that, I've called Vijay Mantri, who's a well-known investment expert, to our studios. Vijay, thanks so much for taking the time, and season's greetings to you and your team and your family as well.
Thank you very much, and thank you very much to you, your team, and your viewers. Happy Diwali, happy Dhanteras, and happy New Year's.
Absolutely. So let's talk about this, because I think a lot of people have gotten used to the idea of going out and buying gold and silver during Dhanteras and Diwali. But from a strategic standpoint, if you leave emotions out of it entirely, and if you had, say, 10% of your portfolio in gold and silver, over the last year that could have gone to 15 or 17 or 20%, simply because of the way that gold prices have gone up and silver prices have gone up. Your strategy would say, take money off the table. That is to sell gold and silver. But then how can you do that on Dhanteras?
So it is, whenever you look at gold, it is very important to learn the most important lesson the gold teaches us, the gold investing teaches us. And the gold investing teaches us that why Indian women are the smartest investor. Why? Just think about that, why they are the smartest investor. Because they have been investing all point of time. They never looked at market condition, they never looked at geography, geopolitics. They never looked at P multiple, what is happening to corporate earning, what is happening to employment. They didn't look at the macro data. They kept investing with the intent not to sell ever. And that is the reason that they made lots of money. So gold investing teaches us very, very important lesson, that you made money in asset category not because you had a view. You made money because you stayed for the long term. So if your view in a gold is 10-year plus, there's no doubt that you continue to keep investing. However, please keep in mind that how does the gold prices move? We know how does various asset prices move. If you look at debt, it has a coupon, and you can figure out that what is the inflation rate, and if the rate of coupon is lower than inflation rate, it means it's not a great time to invest in debt instrument. Perhaps the interest rate will go up, and when you see interest rate much higher than the inflation number, then you can figure out that it's a great time to lock in for the long term.
Because interest rates could go down.
Interest rate would ultimately come down, or it is a great time. So when you see the real interest rate in your favor, you can go for long-term debt product. When you look at equity, there's earning. And from that, you can figure out what is a P multiple, reasonable valuation or not. But what is the most important thing which drive the equity market is that corporate earning. And corporate earnings are driven by, at least in India, driven by what is happening on GDP. But there are some phase in the market where GDP expansion happen, but it does not translate into earning growth.
There's a lag.
There's always a lag, and there's always lag, and the market always go either behind or ahead of what we are seeing right now. Gold is a one asset category which is completely driven by demand and supply, by and large. And what in recent past we have seen, one is that gold has not done well except last 2-3 years. The 10-year CAGR was less than 10%.
And then the catch-up is happening
and the most important reason is that not only dollar debasing, and there's a lot of doubt about dollar, and central banks across the globe are buying. But most fundamental thing is that a lot of money available in people's hand. People made money in last 10 years in equities, truckloads of money. Now when they're figuring out that if you look at the US market, which is 2/3 of the global market, and that market is completely driven by Mega 7, and Mega 7 is completely driven by what is happening in AI. Now people are taking a counter view. Suppose things doesn't work out that way, then what should we be doing? And same thing central banks are doing. So it is a completely demand-driven, gold is complete demand supply driven, and silver prices are packed to gold prices.
Yes.
If you look at 21st century's history, the gold prices has been 65 to 75 times higher than the silver prices. Right now it is 85 times. It means the silver perhaps have more leg left if the gold prices remain this way. Second point to keep in mind is that let's look at 10-year historical return of gold. Except the period of 1970 to 80, where the gold appreciated from $35 to $850, 24-time growth in a 10-year period. And that happened because from 1935 to 1970, gold price was capped at $35.
Yeah, because it was the gold standard.
Gold is standard, so it has to catch up.
Yeah.
After that, we haven't seen 20% CAGR except in November 2011, where 10-year CAGR has been 21%. And in November 2011, 10-year gold return has been 7 times.
Right.
Right now, 10-year gold return has been close to 5 times. It means that the gold price can go from these level by 10-20%. Yes, it can go. So if you have a gold in your portfolio, stay put, don't do anything.
Don't sell.
Don't sell at all. And if you want to give fresh allocation, keep in mind your holding period has to be minimum 10 years from these levels. This is about gold, okay. Silver, however, is much more volatile asset category.
Yeah, it has hit that $50 mark and then crashed after that.
$50 mark after 1979. So is incredible number.
Yeah.
But silver can have a long period where it didn't deliver any return for 20, 30 years. So be mindful of that. So, you know, but it is very difficult to stop the people when they see the tsunami of return. It is impossible to tell not.
So then, from that perspective, if there are deviations in your asset allocation strategy on account of the outperformance of one asset class, which we've seen, 70 plus returns for gold, silver over a certain time frame, right? Whatever, you look at point to point, and we're talking about Diwali se Diwali tak 40+% for gold and silver, right? So therefore, the question that I'm asking is, if there is a significant deviation, how do you correct it? If you don't have incremental money to invest, if you have, of course, you can deploy another asset.
It's come down to basically to how do you look at investing. Investing is future looking, and futures are always uncertain. So you have to do a pre-analysis rather than post-analysis.
Right.
Right now, what we're doing post-analysis, gold has done so well,
Sure.
silver has done well, and equity has not done well. Whenever you create a portfolio, whenever you look at the portfolio, you need to figure out, this is the way my money has been invested. What if the equity doesn't do well? What if debt doesn't do well? What if gold doesn't do well? When we sit with our client, we do this analysis first.
Okay.
The not post-analysis, pre-analysis,
right.
that here I'm investing, suppose I'm giving 50% to my client in debt and 50% in equity. We tell the client, if the equity market perform, your debt portfolio will not look good. We have seen with many investors from 2000 to 2024,
Sure.
where the debt didn't do well, client bola, yahan kahan paisa atka diya hamara. And similarly, when equity doesn't do well, debt will do well.
Fair
So
enough.
I think it is very important to do that in the mind of investor, with the investor. So investor need to look at their asset allocation, how they have been diversified. Look at total gold allocation, just not financial allocation.
Right.
How
So
much
includes jewelry and all of that.
include jewelry and everything, and see how much is that in the total portfolio. It can be anything between 5% to 20% for normal, typical Indian family. For the lower class and middle class, the number could be much higher. But for middle class and wealthy families, the number could be anything between 5% to 20%.
Sure.
I think that is, in my opinion, is more than enough.
So therefore, if it is crossed certain boundaries, which could well have happened if you already had a 15 to 17% allocation, which is quite normal, as you pointed out, for a lot of families, and it's gone now to 25, 30%. What do you do then?
Do nothing.
Do nothing.
It's very fascinating, because the best return in any asset category accrues when it is going through bubble zone.
Okay.
So perhaps it may enter the bubble zone. The best return comes in the last leg of any bull market in any asset category. So we'll see that, and as long as you're holding for 10 years, even from these level, you'll end up making, at least in my opinion, higher single digit return, if not less.
Okay.
From these levels. So in my opinion,
do nothing.
Do nothing, because you also incur taxes.
Absolutely. So point well made. Therefore, let me ask you this. On the equity side, a lot of investors over the last 12 months will have been a little disappointed, right? I hear a lot of people coming through and saying, you know, do I continue my SIP because I've gotten absolutely nothing? Low single digit in certain cases where people have gotten a little unlucky with their selection of mutual fund scheme. Maybe they got swayed by the past returns and they went after a scheme that was an outperformer, and they have gotten negative returns. So what advice do you give to clients perhaps who come to you with this, or people who are saying this?
So I think most of us have been talking about last more than 1 year plus that what return you've seen, you will not see those return going forward. So that is going to play out. So market have three distinct phases. One is that accumulation phase, then there's a growth phase, and there's a bull market. Right now we are going through accumulation phase because what is happening is that the Nifty's EPS is not growing. It is going at very low level. But please keep in mind, if you have witnessed a journey of 2020 to 2025, 24, the journey has happened to most people if they accumulated mutual fund unit from 2015 to 2020. That was the best time to accumulate unit. That's why you could see great numbers on your portfolio. So in my opinion, this is accumulation phase. GDP is expanding, but is not translating into corporate profit as per the expectation of the people. And that's why we're seeing the market moving sideways.
Yeah.
This is a phase we have seen 3, 4 years where GDP expanded. And I'll give some very interesting idea, a number. In 2010, India's total GDP was 78 lakh crore. In 2020, that number became 227 lakh crore. So 3 times GDP growth. But total profit of listed companies in 2010 was 3,99,000 crore, which became only 4,55,000 crore. GDP expanded 3 times, but the market profit had just gone up by few percentage point. What it did after that, from 4,55,000, GDP expanded from 220 to close to 3.60. But the corporate profitability went up from 455 to 16 lakh crore.
Right.
And that is the reason we see the gain in the portfolio for many investors. So right now, in my opinion, GDP will keep expanding. It is a great accumulation phase. Suppose you're a long-term investor, you will not find this kind of opportunity too many times. Accumulate, accumulate, accumulate. A asset category's best return accrues to a person who has the ability to hold it when it is in a drawdown phase or accumulation phase. Everybody expects the bull phase in asset category, but the best return accrues to people who could live through. Suppose somebody who's invested in gold in 3 months, 6 months back, he would have seen 30%, 40% gain in the portfolio. But what about the person who is accumulating from 2012, 2013, 14, 15, when the gold price was 30,000 rupees?
So fantastically put. And therefore, the last question, right, and that has to do with strategy going forward. Would you say that multi-asset funds, and the reason I bring this up is because it has a flavor of gold without you having to, or silver for that matter. There are a few schemes that have gone out and said, I will buy 20% and have done that, 20% in silver, before the silver run-up took place. So it's a very fantastic call that was made. Some have 9%, 10% silver, reduce the holding on gold. It doesn't always work, but it's good from your perspective because the tax implication is not there. If you are not a perma bull on something like gold and silver, and if you're not attached emotionally, do you think that this is sufficient?
Yeah, I think multi-asset fund is a great idea. But when it comes to investing, never ever assume that is without emotion.
I agree with you. I absolutely agree with you.
And the performance of gold tells you, emotionally attached, culturally, part of our psyche, and that's why gold we never sell. And we don't even compare what is happening to geopolitics or anything. So I think the most important lesson to learn from gold is, very honestly, you made money not because of you. You made money because of a holding period.
You held it.
You held it.
I mean, you don't even have to go too far. You can look at statements like, you never sell the family silver. Of course, that is relevant, more relevant today than anything else.
Yes.
But I think it's been a fantastic chat. Vijay, as always, thank you so much for taking the time.
Thank you.
All right, so insight that you can use: don't do anything. Gold prices are going and hitting all-time highs, so are silver prices. Don't do anything is the advice that comes from Vijay Mantri.